If you're involved in the personal finance or in property investment space, I'm sure you've been constantly bombarded by the Kiyosaki books and the media that phrase and claim that cash flow positive properties are the only way to go forward. However, we also have people on the other end of the spectrum who preach capital growth. So what property should you get and how should you invest? Just before I go further on, welcome to my channel. My name is Mihir and I upload educational content such as this. If you're interested, please hit like, hit subscribe. But without further ado, let's get straight into the video. The notion of cash flow positive properties is heavily pushed and preached in America. And we can now sort of see that same sort of ideology being pushed onto Australia. However, there's still a big divide between the two types of investors. The property investor A, who gets properties for the goal of capital appreciation. That means he's basically getting a negative geared property, which is a property that's not giving him a positive cash flow. So he's putting money towards that property to hold it and retain it and maintain it. And that may sound absurd, but I'll explain why. And then on the other spectrum, you have property investor B, who is essentially the cash flow enthusiast. He's like, cash flow is king, cash flow or nothing. So if that property isn't bringing you a net profit or cash flow positive return after taxes and expenses, then that property is a dud. Just stay away from it. That's how they view. Now I'll go back to property investor A, and you may be thinking, why the heck would anyone want to do that? Because you can't necessarily control capital appreciation. And I can explain how they sort of pick their property in just a moment, but that's the whole idea of trying to get a property in a good blue chip suburb, and the range they're trying to get is between 7 to 12%. However, it's generally towards the higher end of that. And you may be thinking, how would they know if it's going to capitally appreciate? And that's a very good question. So what they do is they look at past trends, and not just on a 2-year, 3-year scale, because like, for instance, in this bug time, property prices rise exponentially in areas you wouldn't think of. But that's not accurate because that's like 1 or 2 year sort of time frame. So what they look at is in the wider context of time, so like a 10-year span. So for instance, properties such as Bowen, Kew, areas like that in the eastern suburbs of Melbourne, they've been appreciating around 10%, give or take, some years higher, but around that time frame. And then they look at the overview, then they sort of go deeper. They say, okay, what's happening? Why is this because of that? Then they realize there's limited stock and there's high demand. Okay, where does the high demand come from? The high demand comes from mostly parents who want their kids to go into schools like Bowen High, Kew, Trinity, all that sort of jazz. But they look at for these key principles, such as how much capital growth has been averaging throughout the last 10 years, not 1 year, not 2 years, 10 years. And then they sort of go deeper. They look at the demographics. Oh, are they, blue collar, white collar workers, high income earners and things like that, and then they go from there. And this may sort of rub the cash flow enthusiasts in a very wrong way, because that's against the whole Robert Kiyosaki ideology and their own sort of ideology, which generally stems from that. And they may say, why the heck would anyone do this? And it makes sense, but remember, their goal is different. What they're trying to do is they're trying to get from one property to the other. And that's what you should do, in my opinion, and what I've read from based on other entries, is that you should always look at the next property after this. You got to plan one step ahead. And so what they're trying to do is, let's imagine you have a $1 million property. 10% of that is $100,000, right? So after 1 year, you've acquired $100,000 worth of equity, not to mention the amount of principal you would have paid off during that period of time. So you can use that 100K equity and just buy another property. Rinse, repeat, rinse, repeat. Or if it's a more expensive property, wait maybe 2 years rather than 1 year. You get that process, and they keep doing that. And their end goal most of the time is either to just sell and fully pay off like the 5 properties or something, just so they can get like cash flow returns towards the end. That's like their exit strategy. Or they just use margin and just continually borrow and borrow money. That's what they do. And the problem these cash flow enthusiasts have, or these Robert Kiyosaki fans, is that you're putting away your money and you're not sure if it can give you a return, which I sort of understand. However, based on the empirical data we have, it makes sense. If a suburb has a 10-year span of growing at like 10%, then you look at the demographics, you look at the supply, and then you even see the demand, then you can understand where this is going. But to just determine an asset based on cash flow perspective is sort of ludicrous, because the American property market is completely vast from the Australian, because we have a complete or a shortage all wide nationally. Not to mention our cities like Melbourne and Sydney. There's a shortage like throughout nationally, and even in like the capital cities and cities in general. Just before we go on further, I have a quick disclaimer, something I want to talk about. Negative gearing is not a tax strategy. Let me repeat that one more time. Negative gearing is not a tax strategy. I understand if you're a high income earner earning more than, let's say, 90,000 or whatever you earn, you would want to reduce your tax because, let's face it, nobody really likes paying that much tax. Although it helps sustain us, but if you would, you'd pay a little less tax. Understandable. But you got to understand, yes, you can claim the interest, you can claim because it's tax. And you can claim the depreciation schedule, you can claim accounting fees, a lot of other fees you can just claim. But you still got to understand, if that property is not either bringing money into your pocket through cash flow means, or if it's not capitally appreciating, let's say between like 7 to 12% or even higher end on that scale, you're wasting your time, really, because you're still losing money. Rather than getting a property that's appreciating 5%, you could have gone something that maybe appreciated 8%, 9%. So this is why you got to do a lot more research. And remember, property is an investment. It's not something you can just do to reduce your tax, because how long can you negatively get as well? You got to understand that, because you can claim depreciation for so long and then it will eventually become cash flow positive property. But when it gets to that stage, you would have wasted so much time because you'd be stuck in that one property. And that's one thing I really want to like drill down, is that negative gearing is not a tax strategy. So please do not use it in that means. Property investing is investing. The end game of this is to make money. That's the whole point, whether you're the cash flow side or the capital appreciation side. It's to make money. So now let's talk from the point of view of cash flow enthusiasts. Their whole contention is, okay, Mihir, I understand what you're saying. You know what? Let's say if I did buy the expensive property, it took me some years to build a deposit. Yes, I bought it. But what's the point? It's so expensive to hold. It's draining other aspects of my lifestyle, or it's just too much, too overwhelming. And let's say I fully pay it off. It'll take a long time, but I fully pay it off. Then I'm getting a rental yield of 3 to 4%. What's the point? You know what I mean? And let's say, okay, if I went with your property investor A style, let's say I took the equity out and bought another property. I can't keep doing that because I'm not getting any money coming in. And then the banks won't let me money because I'm not getting money in. So I'm sort of stuck. So their whole philosophy is stuff all that. Let's go to regional areas. Let's go to Ballarat. Let's go to Bendigo. I can get a property there for roughly half the price, and the rental yield is bigger. And let's say I fully pay off that property, then I'm just getting, a huge rental yield. It's like 7, 8%, whatever, after taxes and everything. I have the money coming into my pocket. I can do whatever I want. Invest, pay off my bad debt, my primary place of residence. I can do whatever I want, rather than wait a long time just to get a crappy rental yield. And that makes sense, and I understand. Because most people, they try to invest, or they sort of want to fully pay off their properties, which I understand you want to do because you don't want to be in debt, which is the notion. But many investors, or those guys, they sort of just stay on margin, or they just stay on loan. So they just keep borrowing and borrowing and borrowing. It's sort of like that 4% withdrawal rule for ETFs and the stocks, where if it just keeps going up, you can withdraw a little bit and it won't affect anything else. That's what they do. But I get where they're coming from, and it makes sense. Now let's move on to what an ideal property investor does, or what many successful property investors have had done. So let's talk about that now. In order to become a successful property investor, you can't discredit either one of these strategies because they're both pivotal. Let's say you went property investor A route. You acquired maybe 2 properties like that. They're doing really well, capitally appreciating, but you're not really able to borrow more after a stage because all your money is just going there. There's no way you can sort of service the debt, and that's where the banks have trouble, and why they won't lend you is because of serviceability. Because if you can't service the debt, why the hell would I give you money if you can't pay it back? That's literally it. Like, why would I put myself in a suboptimal position if I give you money and there's a very low chance or a lower chance of paying it back? Why would anyone do that? It makes sense. But if you go the cash flow enthusiast route, yes, you're making money, but how long would it take for you to build a deposit? It'll take years. And not to mention, that's like after tax and everything, that's your hard-earned money, in a sense. Like, whereas that money in property investor A side, it's not taxed because it's just loan, it's just capital. So they can't tax it, which is a good thing. So in an ideal world, what property investors do is they try and get a 1-to-1 sort of thing with a cash flow positive and a capital appreciating property. So there's no such thing as a unicorn property. Let me just get that. There's no such thing where you get like a 10% capital growth property with like a 7% rental yield. If so, that's very, very, very next to impossible. You're not really going to find that, especially on a balance of probabilities and consistently. It doesn't exist. It won't happen. So in an ideal world, we want those 2 scenarios. However, the question you may be asking is, okay, I get that, but where do I start? So if you're a high income earner, let's say you're earning above 80,000, your borrowing power is quite decent. It may take you like maybe a year or two, some time, depending on your savings rate, to save up a decent deposit. And then boom, you can borrow a pretty decent property in a blue chip suburb area. But that will have significant holding costs, but you can still do it. However, if you earn something like, let's say, below 80,000, just in this example, since you don't have a lot of income coming in, it wouldn't make sense for you to borrow a loan. Like you wouldn't really be able to borrow a loan, but not to mention that even if you did, it will have quite a burden on staying on your lifestyle. So if you're earning above 80K, think of like these sort of properties because you have a lot of income coming in. And however, if you're earning less than 80K, think of increasing your income, because remember, you need to service that debt. And if you can show the banks you can service that debt, guess what? They'll give you more money so you can move on to the next property, because you don't want to get stuck. And a key problem that many of property investors do is they go into this, capital appreciating property, which is giving them net negative returns, is that they get stuck and they can't borrow any money, which is what you're going to understand. And that's quite a bit of a mouthful, but a key distinction that needs to be made just before I sort of wrap up this video is that you got to have a strategy. A strategy is paramount to any success. It doesn't matter if you go this route or this route. It doesn't matter. There's many successful people, whether they go in real estate, stocks, even employees, they invested here, they did that, There's many successful things you can do. The thing is, you just got to have a strategy. And the thing about these top performing individuals, even property investors, they have a strategy. So the first phase of their property investment journey is the accumulation phase. This is where they acquire much property as they can, like boom, 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 straight up leveraging. They may have some cash flow positives, will generally skew towards capitally appreciating properties, because they're just trying to like get a quick deposit, get that equity, get another one. And then after a period of time, they may go, okay, let's start reducing our LVR. Let's start paying down the debt bit by bit by bit, and then sort of go. Or like the strategy I mentioned earlier, they'll try and get like 12 properties. They'll sell 7 and fully pay off the 5 properties, the 5 best properties they have. And then boom, you have no debt and you're positive. However, I don't want you to be scared of debt as well, because there's another strategy which I'll sort of talk in my other videos, is that where people live off their equity, so the line of credit. So like I gave you the example with the graph. In the stock market, if it just keeps going up and up and up, like exponentially, and then you withdraw 4%, you'll get to a point where you got to find out your number. You'll get to a point where that 4% doesn't affect it. You'll still keep growing. And that's sort of what these guys do just with debt. And remember, 300K, or let's say you take out 100K, that's not taxed. Of course, you have to pay interest. I get that. But since interest rates are so low, and if you understand debt, many people are just using debt and just abusing it. That's what they're doing. But anywho, I hope this video gave you a good explanation. It summed up a lot of key questions you had and sort of explain this whole topic. But besides that, I hope you guys have a phenomenal day, and goodbye. Thank you.